Well, good morning, everybody. It's my pleasure to be here talking to you about the role of advisors as we go forward helping Canadians achieve financial success and are confident in their financial future. Greg mentioned that some of the challenges and problems in other jurisdictions and the responses that are going forward. I hope at the conclusion of my presentation I leave you with some facts and some research, which is increasing literally weekly on this topic, will empower you to engage more actively with your clients, with regulators, and with those who choose to ask more about what we do. This is a challenging time for you and your clients. It's a point where those unfamiliar with the full scope of what we do will wonder if the advice model is still relevant. As you can see from the title of my talk today, you know where my thinking is on the topic. It's not just my opinion. It's a conclusion based on research and fact. Your role and the role of investment managers, insurers, advisors, and the public sector policymakers have created a very solid support system for our society, one that is balanced with public sector social safety nets, old age security, universal health care access, to name a few, and private sector defined contribution and registered retirement savings plans. The success to date is based on combined programs that in many ways are interdependent. We have benefited from the advice model in Canada. Our job is to ensure we continue to evolve and continue to serve Canadians. 288,000 financial advisors across Canada have been key to delivering government policy related to financial literacy, savings behavior, liability management, tax and tax-incented, government-initiated savings programs, and increased utilization of them. Canada's retirement system ranks among the world's best. We have a very low poverty rate amongst seniors, and in terms of sustainability, Canada ranks relatively well versus other developed countries. Using the Global Aging Preparedness Index for pension sustainability, this is a combined index which uses 3 measures of pension sustainability in one category. The combined index compares countries based on public burden, fiscal room, and benefit dependence, essentially giving a grade to a country based on its ability to match its public and private retirement funding to the pension demands of its aging population. In Canada, traditionally we talk about the retirement program as 3 pillars. I'd like to explore with you today the way that you should think about it and the way we should try and get policy advisors to think about it. It's really 5 pillars. And it's one of the reasons why we have such a successful system today. Pillar 1 is government's responsibility. That's the basic social safety net, old age security. We have government-mandated savings, the Canada Pension Plan. That's about $200 billion in assets. We have government tax-assisted savings, defined contribution, defined benefit, RRSPs, that's $1.7 trillion. I'd like to propose to you that there's 2 other pillars. Individual non-registered assets. Canadians saving outside of tax-incentivized savings programs, those assets today are $1.9 trillion. Non-financial assets, businesses and homes, net of mortgages, that's another $1.9 trillion. All of these resources are available for individuals as they think about, plan, and strategize for retirement, and they should be part of your quiver as you consult with your clients on how they move forward and prepare for retirement. I'm going to touch on it later, but the number one reason in a number of studies why individuals consult financial advisors is it's to save for retirement. So this is an important aspect. The mutual fund industry today is about $800 billion, roughly 20% of total savings in Canada. So it's an appropriate and it's a highly used product in retirement savings today. I'd like to review the most important component in building savings. And it's one that initially in the industry, when I started 30 years ago, we talked about a lot. But as Greg said, returns have been challenged for the last decade. And every study that I've seen really focuses on, it's not what the return is. While the return is important in compounding, the real success to retirement is how much principal do you save. And it's those saving disciplines. And this chart just simply illustrates the power of compounding. If we can get a hold of individuals coming out of university, starting their work life, and getting them to contribute money. In this particular case, it's an initial investment of $5,000, and it's a $500 monthly investment. We chose this one because from that age, you'd end up retiring as a millionaire. Now, that's $250 a paycheck if you're paid twice a month, and it's over an extended period of time, 40 years. That discipline is what you have to instill in every individual. And if they start later, 35, they end up with about half. And if they start even later than that, 45, they end up with about 25% of what they could have had we gotten to these individuals earlier. Now, we took a look at just another simple example, which might be more manageable for many people that are starting out. $1,000 invested in your first deposit, and then $150 a paycheck or $300 a month. And at the end of the day, that's slightly less than $600,000 over that 40-year period. About half that if you start at age 35, and about a fifth of that if you started at age 45. So it's a simple message, but I don't think it's one that we should forget, particularly today. People are afraid of making investments because of the volatility in the marketplace. We've had more 2% volatility days in the last 3 months than we've had in the last 4 years. So this is what people are living with. I'm afraid to put my principal in because it'll be worth less tomorrow, or it may be worth less tomorrow. Let's get them convinced they shouldn't be thinking that way. Let's get them regularly making an investment. Market goes up, they get less units. Market goes down, they get more units. They're continuing to build their principal. If they have a disciplined program, the power of compounding and the power of a savings program will be there when they need the money at the end of the day. The second area I wanted to focus on was market volatility. It's affecting our clients at this time, but what I wanted to illustrate with this time scenario is that $10,000 invested in 1996 is worth $29,900 today. But there's a lot of volatility. But those that think they can time the market, or those that react to market volatility and get out of the market at a time when they're losing principal and don't get back in, this chart illustrates the 10 best performing days in this period from 1996 to 2011. And 9 of those days occurred after 2008. Those were appreciation days through the declines and into the recovery that started really in March of 2009. So that volatility, while people were shy and staying away and trying to understand it, and we were all scared. It was a trying time. But there are returns to be made in the market, and if those individuals that could have capitalized on it, that did stay in the market, were rewarded, as we sit here today, looking at another period of volatility with the returns that they didn't miss in the declines of 2008. This chart tries to demonstrate for you what happens if you miss those 10 days. And the return on a combined basis is about half if you missed being exposed to those 10 days. If we miss the 20 best days, it goes down to about a third. If we miss 1 month, 30 of the best days, it's about $7,500. So the power of being in the market, that consistent savings program, is the message I'm trying to convey here. Now, we all know that bull and bear markets exist. And every time, today, as I sit, the statistics I was looking at yesterday, we have a euphoric and a pessimistic chart that we monitor. Average Canadians today are very pessimistic about what's going on. So that is a key indicator to us as to their behavior and what decisions will be made and what challenges you will have in dialoguing with your clients. But when we go back over time, markets have cyclically gone up, but they go up inconsistently. Generally, a bull market extends for a much greater period of time, and the appreciation is fairly significant, certainly compared to a market decline, which are generally shorter in duration and don't decline as much as the bull market period. And we never know when a bull and bear market are going to start. We can anticipate, we can try and read it, but most of us will get it wrong because they tend to go when we least expect it. In this next section, I'd like to cover the need for advice. I will start with an overview of investor psychology and the needs of real Canadians. So let's start with a review of how economics traditionally models our behavior, but how do we actually behave as individuals? While economic models assume that we rationally go through about maximizing our self-interest, in fact, investor behavior is sometimes a mix of productive and counterproductive behaviors. Essentially, our brain has two centers that are most important when it comes to change in our environment: the amygdala and the prefrontal cortex. I know all of you are familiar with these, even if you don't know the meanings of the terms. You'll know the feelings that I'm about to talk about. Working memory of the brain sits in the prefrontal cortex. It's what enables us to engage in complex thinking. This area contains what is known as the executive function, the ability to initiate and stop actions, monitor and change behavior as needed, and to plan future behavior when faced with novel tasks and/or situations. The amygdala is the emotional part of our brain. The amygdala's job is to alert us to danger. It's hypervigilant about keeping us safe. It views change as a direct threat to our continued existence. Not only does change make us fear for our survival, but when the amygdala perceives change as a threat, it overtakes or hijacks the prefrontal cortex, flooding working memory and diminishing complex thinking. Because we have these two very important systems at work, our responses are highly affected by the emotional tenor of circumstances, so-called hot and cold decisions. This is a far cry from the general assumption about maximizing self-interest. When the amygdala takes over, it causes adrenaline rush. If you've ever been scared in your life, your amygdala will recall that. If you've ever been excited, your amygdala will recall that. Your precortex allows you to think about 5 things at the same time. When the amygdala overrides it, you're quick to decide. You're using about 5% of the available information, and you're reacting. And it's very, very defensive, and it's very, very emotional. We're taught, when we try and get into some leadership courses, to understand one's intent as opposed to react to their impact. And those are very important words, and in communication it comes through. So you will have the intent of calming your client, serving your client, and coming forward. But the impact that they will be reading from you may not be that way. And you will judge your interaction with your client based on your intent, not on your impact. And I would encourage you to really understand the gap that may exist between what you're trying to do in your financial practice and what your client is trying to receive from you. And if we can do this, I can assure you, you will have a much more rewarding relationship with your clients, and it'll help understand where they're trying to go with their roles. As a result of our all-too-human qualities, individual investors are subject to various biases and counterproductive behaviors when they invest. Procrastination being amongst the worst. Delay in starting any type of savings plan. Overconfidence. They believe they know more than they do. Anchoring. Reluctance to make adjustments to investments as they become anchored to purchase price or existing gains. Loss aversion. Twice as sensitive to losses as gains. May be reluctant to invest for significant growth because of these biases. Mental accounting. Look at investments on a piecemeal basis or individually rather than an aggregate. How many conversations have you had with an individual where they talk about the one investment they made 3 years ago that made 10%? And you ask them what their portfolio return has been over the last 5 years, they have no idea. It's chosen thinking, selective thinking. The herding instinct. People tend to follow the crowd, not the plan. It's a false sense of security, doing what everybody else is doing. A second key factor in financial decision-making is time. Most Canadians don't have time to do a good job of planning or investing, and appropriately so. They would have to fit it in after work or in place of family time or while they're dealing with what is, in Canada, or specifically Toronto, one of the longest commuting cycles anywhere in the world, or they have to take it away from relaxation or vacations. So those that rely on people with good training, financial advisors to help, will be more available and more successful in the other important aspects of their lives. As you go down this list, these are real, tangible benefits that you are delivering every day. They are worth paying for. The independent research I'm about to present provides a compelling fact set to support the thesis that there is value in advice, more value than the current cost. I've talked broadly about investor needs. These are the Canadians you serve every day, and you know that they are time-strapped and need an outside expert to properly assess their situation. You know that you have been delivering value. It's been difficult, in light of the market volatility, to have that value documented or discussed in real return terms. But as we dissect all of the value that's provided in those other services, the tangible benefits, we know that you will be a valuable asset in your client's eyes going forward, whether it's for plan preparation and participation, for the organization of financial affairs, for the good savings habits, for liability management, for appropriate use of debt, increased use of tax-incentivized savings programs, or financial literacy that you provide just by educating your clients and/or their family members on basic financial issues. And delivering on these is where the real value is for your client. And we hope that you interact with your clients on that basis. It's not all about return. Return is an outcome. Value is in the services that are provided. What the current research is saying is the value of advice. It is working. The Investment Funds Institute of Canada has commissioned research drawing on statistically robust cross-country survey data from 2011, and I will present some of these findings. Overall, the message is clear. Advised investors feel they are getting the right information about their investments, have more investable assets and higher net worth across all age and income levels. The wealth effect has been illustrated in previous research, and there's a question of cause and effect. It is that advisors are drawn to wealthier clients, or that clients' wealth builds with an advisor. Which is it? We will show the elements of advice that contribute to the wealth effect. Advised investors are more likely to save more often, benefiting from the power of compounding and more principal to live off of. Feel more confident about their financial choices and stick with their plans. It's useful to explore the reasons why Canadians say they use advisors. 74% said they had little or no experience investing when they first sought out an advisor. When asked why they first contacted an advisor, there were a number of reasons given, but the two main ones were they wanted to invest for retirement and they wanted to achieve a better return with overall success than they could do on their own. Advice provides investors with the confidence to set up a savings program. 89% of investors recall their advisor discussing the suitability of mutual funds to their retirement or investment goals. 94% feel very comfortable or somewhat comfortable with the information they had the last time they purchased a mutual fund. 71% are very or somewhat confident in their knowledge of any of the fees they're paying for advice or for investment management services. Later in this presentation, I'm going to talk more about fees to incorporate a deeper explanation of fees into the discussion as it relates to managed money. Over the next series of slides and illustrations, I'm going to talk to you about the advisor wealth effect, which is the correlation between advice and higher levels of investable assets. The Ipsos Reid data indicates that households generally who use the advice model are more financially secure, in fact, on average, 4 times better off. We also know that they are more confident with their financial situation and have a better outlook on their financial prospects for the future. In view of this fact and other benefits, it's not surprising that Canadians overwhelmingly choose advice over non-advice in making financial and life decisions. The Ipsos Reid findings were also supported by a Plenary study, which has consistently found that 80% of mutual fund investors made their last purchase through an advisor, and they rank the value the advisor brings and the solutions provided very highly. Ipsos Reid also analyzed the data at different income levels. The analysis showed that advised households have substantially higher investable assets than non-advised households across all income levels. In lower income categories, the results are more pronounced, 4.6 to 6.8 times as much. Households with advisors are in the dark blue columns, and as you can see across each income segment, they had higher asset levels than households without advice. To further illustrate the benefits of advice, Ipsos Reid divided the sample results by age. And as you can see across each age group, households using the advice model had higher asset levels, with pre-retirement age Canadians benefiting the most at 5.3 to 4.1 times more investable assets than those not utilizing advice. I'd also like to point out to you an interesting phenomenon that we see in our business, and as I've consulted some of our competitors and colleagues in the industry, they're seeing the same thing. It's in the greater than 65. Because of the drawdown requirements of our registered plans, individuals start drawing down in their 60s, late 60s. And what you find is a significant change in mix of registered assets and non-registered assets. So when I was talking to you about the pillars of retirement earlier, we're actually seeing this reality exist amongst our clients as they age. And the other phenomenon that we see is that individuals actually continue to accumulate assets until age 85. And then mortality starts to skew those statistics. But across our client base, we have more than 1 million clients. My colleagues at Investors Group have 1.4 million clients. We're seeing this phenomenon continue to grow. So individuals are continuing to save, and they're not using as much of their money as they were pre-retirement. So their assets continue to grow. So that wealth effect is still there, and they need help, and it's an important aspect for you to think about. We've explored the wealth effect of advice. We will now look into the reasons for this. We all know that correlation does not necessarily mean causation. Advisors may well seek out clients with more investable wealth, but we also see the other side, that advice contributes to wealth accumulation. Here are some of the supporting data points which we will review in the coming slides. Advised investors are more likely to save early and often, more confident about their choices, and stick with their plans over time, use a higher proportion of growth assets, use more registered plans. According to research conducted in 2011 by Plenary, more than half of investors surveyed first started using an advisor when they had less than $25,000 to invest, and 75% had less than $50,000. This speaks to the value advisors are providing to a very broad range of Canadians. The second point of this illustration is that the average length of time Canadians have remained with an advisor is 18 years. This is the value Canadians place on advisors and is a great help in maintaining the consistency of a savings and investing program emphasized on the previous slide. Advised households, twice as likely to save regularly for retirement across all age categories. This is a key finding. Advised households make retirement savings a habit. Remember earlier we talked about the importance of returns and saving early and saving often? This is the evidence. Advised clients are, at all income levels, are more likely to save regularly for retirement. The differences are more pronounced in lower income levels, which is a testament to the value of advice across a broad range of income levels, not just for the wealthy. These two questions really speak to investor confidence and the likelihood of sticking with the plan. These are difficult periods for investors. Support from advisors is essential to keep investors on course to meet their long-term retirement goals. Investors were asked to talk about next year. So they were asked questions in 2006, 2008, and 2010. In 2010, 44% of advised investors with $25,000 or more strongly agreed if they stuck with their financial plan they will be able to get through any economic downturn or expected event. This represented an increase from 38% in 2008, despite the beginning of one of the most severe equity corrections in memory. In contrast, only 32% of non-advised group with $25,000 or more believed in 2011 that their plan will get them through. Following the dip in 2008 was 27%. The second question about confidence, advised investors are more confident, and this is key. As we move from the investor psychology section, keeping a level head about investments promotes greater organization and sounder decisions. These are clues to the causation argument in the wealth creation effect. Greater confidence is more likely to stick with a plan, strong contributors to wealth accumulation, and highly associated with financial advice could be the result. Take the next slide. Some math formulas for you. One of the risks in difficult markets is to lose sight of one's long-term financial plans and opt entirely for capital protection through bank accounts. The top calculation reflects the return that one gets on a checking account today, which is about just under 2 basis points a year. Solving for N, it's 350 years to double your money in that scenario. If we go to a traditional savings account today yielding about 1.26%, it's 56 years to double your money. It's not that it's wrong to think about saving principal and capital, but returns are important. But again, the most important aspect that you can teach your clients is save often and save consistently. That will result in the biggest pool of assets that can be drawn on in the future. Advised investors hold a higher proportion of equity investments. From Ipsos Reid, the next 2 slides explore advised households and asset allocation. Although in recent periods the equity markets have been extremely volatile, experts such as Ibbotson and Siegel are assured that the equity risk premium is a long-term contributor to higher portfolio returns. Looking at Ipsos Reid data, advised investors do have a higher proportion of growth assets in their portfolios. Over longer periods of time, it has the greatest chance of helping clients achieve their saving targets and goals. This is also supported by research from Financial Planning Standards Council. In particular, advised clients held the smallest amount of cash when compared with investors who did their own planning and investors who had no advice or planning. And finally, we turn to the advantage of using the right savings vehicles, such as tax-advantaged registered plans. As you can see from the bars representing Canadians with financial advice, the individual participation is higher in RSPs, RIFs, RESPs, and TFSAs. And follow the age appropriateness down at the bottom. These plans are markedly improved across one's entire saving life, but where it's particularly relevant, the statistics are really meaningful. Whether you're in a retirement area and drawing on a RIF, whether you're saving for retirement less than 65, whether you're saving for a child's education less than 45 years of age, or the TFSA, which is one of the most popular structures, and I'm sure you're talking to all your clients about taking advantage of that well-intended program. So overall, advisors using a mix of products help Canadians through asset allocation, using tax-advantaged registered plans, helping them save early, save often, and have the confidence to stick with their plans. I've provided some illustrations of advisors delivering on very important services to Canadians and the connection between those services and wealth. The chicken and the egg, so to speak. I've also discussed the investor experience through their opinions expressed in the survey data. In this little scenario, the breakfast. Now I'm going to talk about the spend. And I'm going to spend some time looking at costs of investment, management, and the advice, the bill in this model. And we all know any component part. I can raise my own chickens, I can gather my own eggs, I can prepare my own breakfast, and I don't have to pay the bill. If I want it prepared for me, I have to pay a little bit more. I want to talk about that a bit. The mutual fund product fits ideally with the advice model. It's a regulated product, provides access to investments globally, is tax efficient, and offers professional investment management. Over the years, pricing for mutual fund product has changed in response to the way investors and you want to utilize the product in portfolio construction and serving your clients' needs. Mutual fund fees have become a topic of conversation, and we are pleased that they have. Historically, mutual funds were only available to investors via a front-load commission, which was as high as 9% in the 70s and the early 1980s. Today, the industry offers mutual fund products with no upfront commissions and with a multitude of price structures to meet the evolving needs of the investor and your advisory models. There are a series with embedded fees covering advice, and there are now a multitude of series that exclude the cost of advice and provide investment management services only. In addition, there are a number of competitive products to mutual funds has increased, and I note that some of your discussions later are going to talk about that. With these choices comes added confusion. Some manufacturers of mutual funds and other structured products include the cost of distribution in their product fees, and others choose to exclude it. Our industry, the press, regulators, and individuals continually confuse products that have embedded advice in their pricing and products that don't have advice in their pricing. What I'm going to try and illustrate with this chart is it makes it more difficult to assess the cost of ownership across mutual funds and can make it difficult to compare costs across different or competing products and services. But there is a cost, and our studies show that it is about the same cost in all areas. Today, an investor can choose an advisor who uses an embedded fee model that combines the cost of investment product with the cost of advice. This is the most common option in Canada to purchase mutual funds and, in fact, many other products. In this chart, you see on the right the total cost of ownership is the mutual fund managed expense ratio. Conversely, an investor can choose a fee-for-service model. In this case, the advisor and the client discuss and decide on a fee that must be paid directly by the investor to the advisor, usually in the range of 75 to 150 basis points. We've used 1% in this scenario. When the advisor uses a mutual fund product under a fee-for-service model, they select firms who design their product without a distribution fee, or they choose a mutual fund series from a diversified mutual fund manufacturer that excludes the embedded distribution fee. We see how this works on the left-hand side of the illustration. All major manufacturers today offer multiple series of mutual funds with different pricing options to compete effectively in meeting the evolving needs of the investor and the advisor relationships as it relates to the pricing models they choose to operate in. As we can see in my example, when the total cost of ownership is properly defined, the two models are comparable. The mutual fund industry has already structurally evolved to meet the different pricing needs, but we have a communication lag and a lack of clarity in the ability to compare the total cost of ownership of mutual funds and other investment products with tangible benefits received from the investment returns and, most importantly, the financial advice that goes along with those investment decisions. In my example here, the direct cost to own a mutual fund on the left is less than the direct cost to own a mutual fund on the right. The difference in the two products is one on the right includes advice and distribution costs in its fee. The one on the left does not. The fees are different, but so is the advice package received. According to this year's mutual fund investor poll conducted by Plenary, 71% of investors are at least somewhat confident in their knowledge of fund fees. So the industry is doing a better job in communicating the elements of the MERs and the total cost of ownership. This effort was supported by the release this year of the Investment Funds Institute report, Understanding the Management Expense Ratio. The second characterization we often hear is that unbundled arrangement with advisor fees charged separately would be preferable. As I reviewed, our industry already accommodates this option for investors and advisors who choose it, but recent research by Plenary shows that approximately 60% of mutual fund investors in Canada still prefer that their advisor be compensated through fees that are part of the mutual fund fee rather than through separately billed fee. At the IFIC conference, Avi Nachmani, head of Strategic Insight based in the US, presented findings of a study his firm had done comparing the total cost of ownership in Canada versus the United States. He found that when all costs of advice of investment management were taken into account, the total cost before GST and HST were comparable between the two countries. The United States, in talking to him, has evolved much more quickly to the fee-for-service model. Most of the fees that are quoted publicly now and the fee series that are distributed exclude the distribution costs. But the distribution costs are real, and advisors are charging those fees. In Canada, we have an embedded fee model. Greg talked earlier about changes that are going on in UK and Australia. We have pretty strong views that you need a balanced approach. We're concerned that if we were to react and take embedded fees out of the model, we would remove the ability of people to get access to the system. There are an awful lot of Canadians that don't want to pay fees directly. They're quite comfortable to be aligned with their advisor over an extended period of time and have that advisor compensated out of the process. If we go back to an initial investor coming forward and we look at the fees that are charged for a $25,000 investment and you break that down into a minimum wage requirement with the regulatory requirements to open an account, to satisfy your client rules, all of the costs that you have in maintaining and operating your business, it doesn't even equate to a minimum wage compensation for the hours that are spent in account setup, advising, plan preparation, and continuous process. So we would put forward that we need a balance. The market will drive. We're seeing much more use of fee-for-service model. It will evolve. The product has structured itself appropriately. And most importantly, you will evolve your businesses as you're comfortable with those relationships and discussions with your client and react to what your clients want. Our firm hired Bain & Company to do a study in 2010 that compared mutual fund fees on average in Canada to the 15 largest in the country, in the United States. What we did is we took a total cost of ownership because the distribution models are different. In each of the categories shown here, domestic equity, balanced, international equity, and fixed income, you can see that in the red, we're comparing favorably with the 15 largest companies. On a direct cost basis, this would be a $100,000 investment or less into an advisor-sold product. This doesn't include 401k. It doesn't include fee-for-service. This is an advisor-sold product with an embedded fee for distribution in the pricing of the product. It's a lesser percentage of the business in the United States, but it's relevant that the pricing structures that we have for the services that are provided in Canada are truly comparable to the 15 largest organizations. And I might comment that a number of the organizations represented here have more individual assets in their complex than we do as a whole Canadian industry. There are a number of firms in this sample that have more than $800 billion of assets, mutual fund assets under management. We have a very competitive industry in many, many respects. So I'd like to conclude by covering a few points. We've now covered the need for advice, the value that advisors and investment managers deliver, the investor opinions, the costs, which we believe is fair for the services provided. We'll now take a look ahead. Through the survey results, we've shown the results of your hard work. Clients are better off for having worked with you. The many elements of your value proposition, setting targets, using the right products, helping with the appropriate asset allocation, are all having an impact. Disciplined savings is one of the most important. Looking ahead, if you think you've been needed in the past or now, just wait. There are 10 million baby boomers in their late 40s now to retirement age. As Canadians age, the complexity of financial planning increases, and so does the need for financial advice. Investor Economics predicts that by the year 2020, nearly 28% of Canadian households will be age 65 or older. In the 10 years from 2010 to 2020, they are projecting that financial wealth in this group will double to $2.1 trillion. If you follow the thesis that market returns might not be generous over the next decade, that means people are going to be saving more for their retirement. We are seeing a change in behavior. We're seeing deleveraging. We're seeing more savings. This is your value proposition to your clients. We encourage you to continue on that model. But we also throw the gauntlet down. You're going to need to continue to educate yourself. You're going to need to continue to strive to provide better services, more complete services. That's your challenge. I think what we'll find is that investors and clients will respond to you taking that action and providing better quality research to the more complex problems that we're all going to deal with as we age as a group. But I'd also remind you, if you started in this business 30 years ago, it was a very simple model. It was open a pre-authorized checking plan for an individual and help them save and grow. That model is still relevant for the 22-year-old that is graduating today. The success of our retirement program is because we have a great combination of public and private sector tools. When we drill down into the adequacy of retirement program today, we would conclude that there are pockets of individuals that are not well served. Most of the concern goes to young Canadians who have not yet begun to save, and to older Canadians who didn't heed the advice that you and others were giving and didn't put enough away or couldn't put enough away. We can't change where they are at 65 to 70 years old. The government is going to have to look after that problem. The private sector and you can look after the younger Canadians that have time on their side. Those charts that I showed you at the beginning of the presentation, the power of compounding, the only answer is to convince and educate young Canadians to save money in a disciplined manner, and they will be looked after through the power of compounding and through the power of your advice. I thank you for your time. I thank you for what you do, and I hope that you found my comments useful in your practice going forward.